Okay, so this analysis report on BigBear.ai kicks off with a very strong, very clear thesis that the recent 6% price drop isn't a problem, it's a gift.
Right, a buying opportunity. And the conviction is there, you can feel the energy. But for an analysis this deep, the logic and the math have to be just as strong as the enthusiasm.
And that's our first area to dig into, isn't it? The valuation defense.
Exactly. The report needs to more directly connect the record cash position to the high valuation, moving beyond just treating the cash as a safety net.
So the analysis does a good job of identifying the core bear argument, which is the high price to sales ratio. It's sitting around, 16 times?
16x.
And to counter that, the report just sort of separately mentions this massive cash position of $456 million. And that's the weakness right there. It's treating that cash pile like a fortress balance sheet.
Right. Which sounds impressive, but it positions the cash as a passive defense, a floor. It doesn't use it as an active tool to justify why the premium valuation makes sense.
Especially when the whole company is valued at, $2.3 billion. That cash is a huge chunk of it.
It is. So if you're going to acknowledge that a 16x PS is high, you can't just wave the cash at the problem. You have to actually bake it into the equation.
I see. So the suggestion for improvement is to bring in a metric that actually accounts for that liquidity. Something like enterprise value?
Exactly. Or at least adjust the PS calculation. Because, PS can be pretty misleading in a situation like this.
Can you unpack that a little? Why is it so misleading here?
Sure. So price to sales just takes the total market value and divides it by revenue. But that huge pile of cash is already included in the market value, in the price part of the ratio.
So it's inflating the numerator.
It's inflating the numerator without really reflecting the core operating business. Enterprise value, or EV, corrects that. It basically calculates the value of the operations net of all that cash.
So it answers the question, what are you really paying for the business itself, separate from its bank account?
Precisely. And that's not just better math. It's a much stronger argument. You shift the conversation from, is this valuation too high, to look how reasonably priced the core business is once you account for its war chest.
Okay. So for concrete examples, how would you write that in?
Well, the most direct way is to just calculate the enterprise value. Show the reader the effective multiple they're paying for the operations after you back out the $456 million in cash. It's going to look a lot more attractive.
And the other way?
The other way is to frame the cash as an offensive weapon. Explicitly detail how that money enabled, say, the Ask Sage acquisition. Prove that the cash is an active driver of future growth, that it's being used to buy revenue and tech.
So you're not just defending, you're going on offense. It's not a safety net, it's a strategic opportunity.
That's the shift. A huge one.
All right, that makes a ton of sense. Let's move to the second key pillar of the report, which is this idea that BBAI has hit an inflection point. This is, the real narrative heart of the thesis.
It is. But the claim that BBI has reached an inflection point just by posting positive net income in Q3 requires a lot more context to really land.
The report leans very heavily on that single number, right? The $2.5 million in positive net income for the quarter.
Far too heavily. It's a great headline, I get it. But relying on one quarter without any of the surrounding operational context, a skeptical reader is just going to see it as a potential anomaly.
Like a one-time licensing fee or a big contract milestone that isn't repeatable?
Exactly. You have to preempt that skepticism. The analysis needs to provide supporting evidence, something that anchors this Q3 result in a much larger story of operational improvement.
So how do we prove that $2.5 million wasn't just a fluke?
The key is showing that it's repeatable. So, for some concrete examples, one way is to just drop in a few breadcrumbs of data from previous quarters.
You mean like revenue trends or something?
Even better, gross margin improvements leading into Q3. If you can show that the company has been getting steadily more efficient, then that net income result feels earned. It feels structural, not random.
It shows the company is just fundamentally healthier.
And then there's the even more powerful way to frame it, which ties directly into the acquisition story.
Ask Sage.
Ask Sage. The report needs to really elaborate on the nature of that acquired revenue. It's not just any revenue. It's sticky, generative AI revenue for government clients.
Which means high barriers to entry, long contracts.
Deep integration. The analysis should project how integrating that specific revenue stream makes the Q3 profitability not just repeatable, but scalable.
Ah, I see. So you use the defensibility of that new government AI revenue as proof that the corner has actually been turned for good.
You got it. You transform that 2.5 million from a piece of history into a proof point for a predictable, high-margin future. That's how you sell a real growth story.
Okay, great. So let's talk about the third piece of feedback, which is about the structure, the flow of the whole analysis. I actually love the energy of the GIF thesis, this idea that savvy investors wanted this dip.
I agree, the energy is great. But the structural sequencing of the analysis actually weakens the core GIF thesis by separating the immediate technical justification for the dip from the fundamental reasons to buy.
The weakness being that it leads with the urgency of the gift, this price drop, but you have to wait until the very end of the report to find out why the specific drop matters.
Exactly. The discussion of the crucial technical support zone, that 575 to 580 level, it's buried way in the back in the price targets and technical section.
So the reader is left hanging. You're telling him it's a gift, but you don't immediately explain the box it came in. It creates this disconnect between the event that triggers the whole analysis and the actionable entry point.
Right. You need to validate the reader's intuition right away. Make them feel smart for seeing the technical setup before you layer on all the fundamental justification.
So the suggestion is to integrate that technical discussion much earlier.
Immediately, you have to solidify the logic of why this specific 6% drop is a healthy discount and not, the start of a collapse.
So how would you actually do that? What are some concrete ways to restructure the report?
Okay, for one, you could move that whole discussion of the 575 to 580 support zone right up into the initial context section, right after the hook.
So you frame the dip immediately as a technical test of a key level, not some random panic selling.
Yes. You're telling the reader the chart planned for this. It makes the technical data serve the core narrative.
I like that.
And then, to build on that, instead of just saying a pullback was inevitable, which is a bit generic, you can use the technical data to explain why.
You mean like the RSI, the Relative Strength Index?
That's the one. You mention how overheated the RSI was after the 150% run-up, and explain that a cooling-off period down to the 580 area was not just likely, but healthy.
So it makes the drop feel targeted. It makes it feel planned. It reinforces that key line you mentioned. We wanted this dip.
100%. You ground the immediate call to action in data, and then the rest of the report, the fundamental case, feels like the long-term justification for why you were so smart to buy at that level.
That really flips the structure and makes it so much more powerful. So just to recap, we have 3 really clear, actionable areas for improvement here.
We do. We started with great data and great conviction. The first point was about better integrating that huge cash position into the valuation thesis.
Right. Moving from a simple PS defense to a more robust enterprise value calculation.
Second was about strengthening the evidence for that Q3 profit being a true inflection point.
Which we do by adding context on operational efficiency gains and really spelling out the future impact of that sticky Ask Sage revenue.
And third, streamlining the flow of the entire piece to align the technical trigger with the fundamental justification.
You maintain that urgency by explaining the why now right at the beginning.
The thing is, the underlying data points are all exceptionally strong. The $456 million in cash, that Q3 net income, the Ask Sage acquisition, it's all there.
It is.